Your house is worth whatever it's worth, right? Whoever sells it. Wrong. I'm Charlie. Welcome to Moving Home with Charlie, and thank you for coming.
Charlie Landing grew up in Sussex, is the founder of Best Agent and presenter of Moving Home with Charlie.
If you want to find one of these guys, look out for those compassionate professionals. All estate agents are not the same.
So Charlie, what would be your advice for people interested in buying new builds right now?
Don't overpay. Do buy, but don't overpay. That's why I say disregard the guff. Read into the numbers and look, and it's buried. The bad news is buried in the small print, okay?
Good evening, everyone. Welcome to the Property Press Awards.
They may or may not be telling the truth, but you should form your own view. Get out and view, get out and view, get out and view. You cannot be in a position to make offers and have the offers accepted if you're not viewing. Just be out there viewing. Pay attention to the back of the class. If you've not been watching my videos, I did one just a couple of days ago. Disregard the guff, guys. Good evening, everybody, and welcome to another live stream. This is Moving Home with Charlie, and this evening we've got a very special guest. Joining me this evening is Director of Research from Zoopla, Richard Donnell, who has been on the channel before, but not for some time. And this evening we're going to be going through the House Price Index publication that, Richard, I believe you're the author of it, right?
Yep.
And picking his brains on some of the numbers in there, having a bit of a chat about the market, and just, totally unscripted chat. And we'll be taking your constructive questions. So if you've got a question for Richard, please put it in the live chat, but please make sure you mark it nice big letters, question. Otherwise, I'm not going to be able to pick it out so easily, and I haven't got any help on that. We are going out on Moving Home with Charlie channels and on the Best Agent channel this evening. So we've got a mixture of movers and agents watching this, because the whole point of this channel is to do everything in my power to help movers and agents get along a bit more easily, help more transactions happen in less time. And so I've always said, despite lots of my cynicism about various house price indices, I've always said that I think Richard's Zoopla House Price Index it's the one that makes by far the greatest effort to be the most thorough and wide-ranging. In fact, Richard, why don't I start by asking you if you would just give, in the most simple layman terms possible, a little bit of background of what comprises Zoopla's House Price Index and how it differs from the other ones.
Yeah, well, look, great to be here, Charlie, this evening. So look, Zoopla's House Price Index, I helped create and set up over a decade ago when I worked for a data analytics business called HomeTrack. That's one of our sister businesses to Zoopla at the moment. And so what we use is, we do something quite different to all the other indices. We use a different methodology. It's called a repeat sales index, or a quasi-repeat sales index. It's quite complicated, but we use a lot more data. We use sold subject to contract data from Zoopla. We use Land Registry and Registers of Scotland transaction data, but Land Registry has got a really bad lag on it at the moment. So that's a real hindrance for a lot of people who rely on that data. And then we use mortgage valuation data. HomeTrack's a big valuation business for banks. So we get a lot of valuation data that surveyors are carrying out. And so we put that through the model. And and the other big difference we met to the others is we weight to the stock of housing. Our index is more like a super tanker. It's much smoother. It's got less month-on-month volatility, and I think that's sort of right, because the whole idea of a house price index is that it's sort of it's supposed to represent the whole housing market, basically, the value of all homes, not just the value of what's transacting. So again, our index doesn't necessarily grab the headlines from being up 2% one month, down 1% the next. Drive some great media coverage. We're just trying to sort of give an overall sense of the direction of travel in the market.
Fantastic. And I just had a brilliant question and now it slips out of my mind. But yeah, you were just saying, so that's right. Here's the question. So earlier in the year, Zoopla, Rightmove, Knight Frank and Savills all revised down, I think I'm right in saying, their house price growth forecast for 2025 in the UK. I think Savills had the highest one, saying 4%. And I think you and Rightmove were probably around about 2%. and you've all come down to the 1%. That's quite unusual for the high-profile housing market commentators to sort of in unison go, okay, we've all got to rethink this. I'd love to. What can you say about that?
No, look, it's great. I think it's being really honest and giving a bit of a trade secret away. I mean, I hate to be in the middle of forecasts. I either want to be at the top or at the bottom, basically. And I think we've consistently been at the bottom for the last couple of years. I think we've seen a recovery in volumes, but we don't see necessarily the recovery in prices because of the affordability problems there are. And again, look, I think I like to typically stick to my forecast. There used to be years ago way more focus on these numbers and whether they were right or not at the end of the year. The BBC would even do a review of all the forecasts, but there's so many forecasts now. And I think in line with everything else these days, I think people are more likely to give real-time adjustments to their forecasts. I mean, you don't want to change it all the time, but around about the mid-year, if you kind of doesn't look like your 2% is going to be right and you think it's going to be closer to 1, well, say it. But going from 2 to 1, again, compared to where we were over the previous years, I mean, people used to say 6 or 7, and it turned out either much more or much less. So it's all getting pretty narrower. And again, I'm sure you said, Charlie, many, many times, there is no single housing market. It's almost an irrelevant number, isn't it, basically? Only about 1% of home.
Hallelujah!
Only about 1%. I mean, the thing about UK house price indices is they're more of a macroeconomic indicator for the Bank of England and economists. When it comes to the 20 million private homeowners in this country, and if you add the 5 million landlords in, or the 5 million rented homes, I mean, it's everyone's home is performing differently.
Well, that's let's actually crack into your index itself, if I may. Sorry, let me get that so we can actually read it. There we go. So these are your headlines. And what I'm going to do is skip over the obvious stuff that people have seen, but you're currently saying that the overall value of the UK housing stock is 1.4% up compared to this time last year.
Yep.
Okay. And that is nominal. Is that correct?
Correct. Yeah. Everything we publish is nominal. Yeah.
Which means that it's well below the government's current inflation level, whether it's CPI or CPIH, it's around 3.84%, isn't it? So what does that say about house values?
Well, it just says that we're still adjusting to the impact of mortgage rates going from 1.5% in 2021 to 4.5% today, basically. It's really positive. We've got incomes and earnings rising. Mm-hmm. But there's a big affordability adjustment. You know, that jump from 1.5 to 4.5 meant that people could afford they could afford 20% less. And the fact that house prices haven't fallen, but they've just risen very slowly over the last couple of years, a lot of the heavy lifting's been done through incomes growth being fast. I mean, again, the OBR say this year is going to be a very strong year for incomes growth. You know, earnings have been rising at 5 to 6% a year. Yeah, the challenge is more a question of disposable incomes. How much money are people keeping in their budget? So, for me, the housing, there's real house price falls. House prices rising more slowly than earnings. They're rising more slowly than inflation. The housing market is adjusting to less buying power, basically, amongst households. And there's quite a big difference, as we'll come on to, I'm sure, about, you know, across southern England, house price inflation is less than 0.5% across all the regions in southern England. But if you go to more affordable markets, which is the stat there on the right-hand side, that in housing markets where the average house price is less than 200,000, you've got house prices rising by double the amount because affordability is less of an impact. Those higher rates have had a less of an impact. You go to markets over £500,000, prices are flat, basically. But again, I'm sure people are having to have to be more realistic about the size of the offer they're going to accept below the asking price. But I'm sure we'll come on to that. But it's varying around the country, and we need a period of low house price growth for affordability to help repair itself.
Well, I'm happy to hear you say that, and I agree. And as I've been saying for years, the best way to move from the position where we were a few years ago, where the house price to wage multiple was I think it was 9, and now we're down at 7.5. the best way for that to happen is for house prices to nominally flatline pretty much. And actually, I remember you saying that a couple of years ago, that you were expecting pretty much not much growth nominally in house prices for the foreseeable future. I remember you saying that.
Yeah, when I was on you, I mean, you were in full voice on the big price reduction, and I was just gently suggesting it might be more of a flat line, but
that's right. And I think, whilst I'm aware that average nominal prices have not fallen by any significant amount, if you were to look at, separate out England from the other countries, separate out the north from the south, separate out the top from the bottom of the market, at the higher end of the market, detached houses in the south of England, as well as flats in central London, have taken an absolute beating, but there's no easy evidence for that. And so I think this is feeding into the problem where a lot of downsizers, including downsizers who are trying to be realistic, are just getting absolutely blindsided by what's actually happening. And I think, as you said, the market is adjusting to buyers' new budgets, and not just the budgets for purchasing, but the budgets for heating and maintaining these big old drafty houses. It's a completely different prospect financially now. Right, so let's have a run through your executive summary, which for some reason I can't slide right. Let me. It's okay. I think we've got enough. It's good enough. So house prices, we covered that. So pre-budget tax speculation hits activity for higher value homes, and demand is down 11% for homes priced at $1 million plus, and fewer new listings over $500,000. Now that's interesting. The fewer new listings over $500,000 is perhaps contrary to what we might have expected. What do you reckon that's down to? Is it just wait and see? Is it panic?
Yeah, I think so. I think what we had is, I think there was 2 articles in about 1 week at the mid to end of August, one in the Times, one in the Guardian, one trailing the abolition of stamp duty and the replacement of an annual property tax for homes over £500,000. And then there's a separate story about charging capital gains over on gains on properties sold over £1.5 million. And lumped into all of that was, let's have a revaluation of council tax, etc. And again, interesting comments from Andy Burnham earlier this week about taxing the South harder on property. So I think and I think there's always the usual pre-budget speculation. This appeared slightly more placed and planned to sort of just kind of roll the pitch, see what the views were out there. And again, I think, and look, I think the papers picked up on it pretty hard. They ran a lot of stories. The BBC ran stories. And so I think it's, and look, a third of homes for sale on Zoopla today are over £500,000. If you're in London, it gets up to about 60%, or I think it's a much bigger number. And so I think if you read all these headlines, and if you don't need to move, or you're thinking about moving, or thinking about putting a house on the market, on the one hand, you're thinking, well, I might save a load of money on stamp duty. So maybe I'll wait and see. But on the other hand, you're jumping out of something no one likes, which is stamp duty, which 60% of the stamp duty bill falls on London, the South East transactions. And you don't know what you're jumping out of the frying pan of the stamp duty into the fire of a new annual property tax, and how big that is and how many years you're going to be in your property. You're going to want to know what that is before you think about what you're going to offer for a property. I think that the CGT got less trailing, but again, I think, so anyone who doesn't need to move or isn't really desperate to move in that sort of over £500,000, over £1.5 million, might just be waiting now. And so there's just a bit of it's more of a cooling really than a massive drop. It's people who just don't need to move and now just waiting to see what comes in the budget, I think.
Yeah, I found it very frustrating how much this teasing, these rumors and these leaks, and just how much that genuinely impacts liquidity and pipelines and actual time to move in the market. It's very, very frustrating. Okay, so you're saying that under 200,000, prices are up 2.8% on average. Now that's not surprising, is it? Because at the first time buyer level, whilst availability of finance may vary and that kind of stuff, there's always rampant demand from people to buy their first home. There always has been. Right now, people are 11 years older than they used to be when they're buying one. And of course, people that average age of a first-time buyer would go down if they could afford it, wouldn't it? So there's never a shortage of people wanting to buy first-time properties. There's just a shortage of money, either a shortage of a deposit or the mortgage multiple not being enough to meet the prices that they need. So it's understandable that below 200,000, especially given that you can now get couples who can get 4.5 times their joint earnings, right? Well, that's, even if you're a minimum wage, that's still 200,000 quid.
Yeah, no, I agree. I think outside the south of England, well, I think number one, UK Finance has said there's been a 30% uplift year on year in first-time buyer numbers in the first half of 2025. One of the reasons for that, despite the ending of stamp duty reliefs, was about 5 months ago, all the banks changed the way they stress test mortgages and test affordability. And so a lot of people using a mortgage, in theory, could borrow 20% more money for the same household income and for the same mortgage rate. And so there's more mortgage on the table than there was 6 months ago. And what we're seeing is first-time buyers. A lot of this, again, is coming in the Midlands, the north of England. You've actually got, when we look at what first-time buyers are looking to buy, those prices are up 5, 6, nearly 10% on what they were a year ago, basically. Much higher than the growth in our wider house price index. So, and again, we put out a press release. We did our house price index 2 or 3 months ago. I think Blackburn was the hottest housing market. And we got a great quote from an agent in Blackburn saying, 2 years ago, a starter home, a 2 or 3 bed starter home in Blackburn was 75 grand. And now I'm selling them for 150,000. Wow. And so, there's just some catch-up growth, especially in towns and cities adjacent to bigger cities like Newcastle, like Durham, like Leeds, Bradford, like Manchester. So, and again, I think Oldham is still right up there, over 4% in our index at the moment, year on year. So there's definitely some activity, and I think that's what's driving that higher growth. And again, higher mortgage rates have had less of an impact on those kind of markets. Higher mortgage rates have really hit the expensive housing markets where, every pound of debt costs you more money.
I think there's a massive misconception amongst a lot of people that if you're buying a £1 million or £2 million house, it means that you're rich. And people are assuming people have just got cash to buy them. But actually, they're amongst the most leveraged of everybody, aren't they?
Yeah, no, I agree. When you look at the profile of debt across the UK, it's all sitting there in London, the South East, basically. It's sort of, yeah.
And that's exactly the demographic that, as Housing Stig foretold several years ago, was going to get hit the hardest by these interest rate rises. And he's been absolutely right. The other myth amongst a lot of people is that rich people just stay rich no matter what happens in the economy. That's not true either, as we can see. So the north-south divide in price inflation and activity widens. Weaker southern England, stronger rest of the UK. So that's interesting. Yeah, and that makes total sense. Have you seen anything to suggest that there is any kind of migration from the south to the north of people seeking better value?
We definitely see for people in southern England looking to buy property, more people are now looking much further afield. A lot more people are looking out of area. The old adage that 75% of people move within 5 miles of where they live today, that's just not reality for first-time buyers and people looking to trade up. I think the other thing, I was looking the other day at the number of jobs in the London economy continues to grow. But since the Brexit vote, the number of 25 to 34-year-olds has just flatlined, basically. And you're thinking, well, who's taking the jobs of the 25 or 34-year-olds? Or are they going to Birmingham? Are they going to Manchester? So I still think at the end of the day, the big economies around the UK draw in employment and people. And so I haven't got any data on it, but I think that, and there have been articles about the fact that is Manchester the place that's attracting more inward investment and graduates are staying in Manchester or Birmingham or other big cities or Edinburgh or Glasgow. And I think, London still remains, unfortunately, very expensive for anyone to rent or buy. Yeah. And it's probably having a bit of an impact on the London economy, basically.
Absolutely. You've also made quite a worrying comment here that market activity is set to plateau in the coming weeks. Do you want to just...
Yeah. So I think what we've seen, Charlie, is the housing market got really hit for six when that sudden, the Liz Truss budget, mortgage rates going from say 1.5% to 6%. Again, we avoided house price falls, but we had quite a big drop in transactions. I think we went right the way down to 1 million housing transactions, well below the average. But what we have seen is a really strong and sustained recovery over the last couple of years, over 2024 and into 2025. And I think the housing, we're saying the housing market's going to get back to nearly 1.15, maybe a little bit more, 1.15 million transactions this year. The last 10 years, it's been about 1.2 on average. So we're getting back to average transactions. And because more interest rates are not going to drop as much as everyone thought. We don't know what's coming in the next budget. There was quite a big increase in national insurance for employers, which has impacted their desire to employ people. The government more or less signaled over this last few days that there's more tough decisions to come in the budget. What does that mean? So I think I just think we're going to we're at a healthy level of transactions. We've got a very big pipeline of deals going through. I just don't see the sort of impetus for that to sort of power on upwards and upwards. Okay. But it's really just plateauing out at a sort of a decent and sustainable rate. I don't see it falling, but again, I just think this budget uncertainty. If you have a third of homes for sale are over £500,000, if a third of the market starts to get the jitters about what might be in the budget, that's on property. And then obviously if there's speculation about what might happen on tax and how much money you have in your pocket, it's just people are going to pause for thought. But equally, we still have a record number of homes for sale on Zoopla. That's a clear signal that people want to move home, right? They want to get on and make decisions, downtrade, move to a different part of the country. People can't put their life on hold trying to second guess what politicians might do or what might happen in the global economy. And I think, funnily enough, this year has actually been an okay market. I think it's brilliant that we don't have a lot of house price inflation. We need just enough house price inflation to give people the confidence to put their house on the market, know someone's not going to make a crazy offer, and we want more people moving. It's in everyone's interest that people want to move. And again, we did a survey earlier this year. Lots more people would like to move in the next 2 years than will move in the next 2 years. And so the opportunity here is how do we encourage people to actually get more confident and comfortable in an uncertain world of making decisions? And so, and a classic example is this looking out of area. I mean, if you go to a Zoopla search box, you go to a Google search box, it's an empty box. You've almost got to know where you want to live to go to find. And so I think that's a real opportunity area here, is about how can agents, how can property portals, how can we actually help those people that want to move but don't know quite where to live, but know what they want and what they can afford? How do we help unlock that? And so I think that remains the big opportunity, actually, to get more people moving.
Well, my answer to that is that if you can solve the overvaluing problem, a lot more people will move. And it's not just because asking prices are too high. It's because, and I get this almost every single day from buyers, we're out there looking, but things are priced so high, there's no point in viewing or offering. And I always say, if they've been on the market a long time, go and view them anyway. Make your offer anyway. And I genuinely see the overvaluing and overpricing happening as just killing. I actually heard from the horse's mouth, firsthand, was repeated to me what a senior manager at a very well-known national firm actually said to his team. We are overvaluing to make sure we get all the stock. It means we're not selling anything, but at least no one else is getting the stock. Like, who's that helping? Who's that helping? It's so, this is the problem. More those buyers out there, the ones that you refer to in your research that would like to move but can't. If asking prices came down, I don't even think necessarily transaction prices would move that much, but asking prices could just ease. And if overvaluing could stop, it would ease a lot of that status and unlock a lot of that economic opportunity and social mobility opportunity. And this is where, so I have before I forget it, I'd like to put hopefully a gentle challenge to you as the author of a well-known house price index, which is that for those of us in the industry, we know that there are pockets of the country where certain houses have seen really quite painful price falls, painful for the owners, right? Significant drops. We're seeing actual transactions happening now at 20, 30% in anecdotal examples, but still 20 to 30% below 2022 prices. But it gets no coverage. Now, the Financial Times did a piece on central London and about how some boroughs of central London were seeing very big price falls on flats. But the rest of the country gets almost now. And to your credit, in your house price index here, I'll scroll straight down to it. You have actually said you've and this is the only place, the only index that I've seen this happen. House prices are falling. So after you've talked about where they're rising the fastest, and talk about where they're also falling. But you're saying by more than 1% across parts of southern England, with the largest drops in Bournemouth, Truro, Exeter, Torquay, and central London. But falling by more than 1%, the 1% number makes it sound like, 1%. Who's going to care about 1% when they're asking prices 5% above what we're going to accept? And there is no acknowledgement ever by anyone in the industry that, yes, there are pockets where there have been notable, significant house price falls. Okay, only for detached houses. Okay, only in certain areas. But I hear from sellers all the time saying, we thought we've been realistic. We're trying to be realistic. Everywhere we look, we're told it's okay, house prices aren't going down. But then we got tumbleweed, no one viewing our property. And we've dropped the price twice and still no one's viewing our property. What's going on, they say to me. And so I think there's a disconnect between the national news narrative on the housing market and how, well, transactions are okay and overall average price movements are okay. So, hey, everything's okay, everybody. But there are tens of thousands, if not hundreds of thousands of sellers on the market now going, doesn't feel okay to us.
No, I agree. And I think look, you and I have had this chat before about overvaluing and things. I think there's a couple of observations I'd make. Look, I haven't done the analysis on this, but I do think there's a lot of people who put the trouble is, before someone puts their house on the market, they often find what they want to buy. And so they then know what they need to pay for the next property, and they work out how much savings they've got and whether they want to take more mortgage. And I do wonder whether they reverse engineer back to, what do I need to get for my home?
That is happening. I mean, I heard it at the coalface. I was with an agent today and they told me that's exactly what's happening.
And so that's the challenge. Is I think what we need to do is we've got to find ways to get consumers more realistic before they even speak to an agent. And that's what Zoopla is actually trying to do, basically, with helping, because I think one of the jobs we see is, how do we help consumers have a slightly more accurate, better understanding of what your home is worth? And we've even got a widget now, or a tool within our sort of online homeowner. So we've got this thing where homeowners can track the value of their home. They can follow as many properties as they want. They get a monthly update of what the property estimate is. But we've created a tool now where they can actually have a slider going, what if I try and get 10% more than this price? And it literally tells them how fewer searches they'll get and how fewer inquiries they'll get. Mm-hmm. And so I think what we need to do is pre-prime consumers to realize that price does impact interest, viewings, etc. Because the question I would encourage everyone to ask an estate agent when they come round is, okay, that's what you think it's worth, but if I absolutely had to sell this property, absolutely guaranteed within 6 weeks of listing it, what price should I put it on at? I mean, that's the question no consumer wants to ask. Probably the agent might feel slightly uncomfortable answering it, but that's almost the elephant in the room question, isn't it? Basically, it's the sense of it's because you can, and if you do, if the agent would have answered that question by saying 250,000, but you need 300 to get your dream next home, but I think the point for me is that the homeowner, the seller, has just got to realise those two numbers, realise there's a risk that they might not get 300, or someone might turn up out of the blue in the next 12 months and pay it. But again, I think it's that expectation management of price to interest to viewings, etc. But I think if most consumers, and again, I need to test my theory on this. So my thesis is most people find a property they want to buy before they instruct an agent, and they're almost sort of locked into needing a certain price for their property, basically. I think that's the challenge. And so the thing I've never tested is with consumers is, when you get the agent round, how many agents are being encouraged to put it on the price they need to unlock their next move, or how many people are trying to max the value irrespective of whether you need to buy another property or not.
Well, I was having precisely this conversation today with an agent in their offices about how many buyers they've got on their books with properties to sell who don't want to publicly put their house on the market until they've found something to move to, and until they've had an offer accepted, so to speak. But of course, the problem is that the sellers of the house they want to move to aren't accepting offers from people who haven't got the house under offer. So there's a chicken and egg. But what I would say to people in that situation is, don't presume, especially if the home you want to move to has been on the market for quite a long time, don't presume that asking price is the price you have to pay. If the asking price of that home is actually accurate, it'll sell too fast for you anyway. But if it's been on the market for a while, whatever uncomfortable reduction you might need to take on your property, you're going to be able to get it on the next one, most likely. So, and I think, well, let's listen. There's still lots more to go through in your report.
I think just to build on that, Charlie, I think the final point, I mean, look, we do track the percentage of the asking price achieved. But I think this is the big thing about the housing market, isn't it? It's like, the housing market and house price indices and all these measures of activity are only where there's a willing buyer and a willing seller. To your point, there's no index of what's not selling, the price of it, what's having its price reduced, all this, that, and the other. So there is a sort of total, all these stats we talk about all the time, mortgage approvals to buy a home, how many homes are listed for sale, how many homes are selling, the prices achieved, the percentage of the asking price achieved. But you're absolutely right. There's a whole other story of what's not selling and why. And so I think that's the big challenge with all of that stuff. So I think but I go back to, I think, it's quite easy in this country to list a property, right? If you suddenly see a property, you fall on Zoopla, on an alert, or whatever, you fall in love with it. Next thing, let's put a house on the market. How much have you really thought about what your home is worth, what it could be worth, how much interest there would be? And again, how practiced, if you've been in your home on average for 8 to 20 years, again, I'm sure you've got it, Charlie, is there a sort of 5 questions you must ask every agent when they come to pitch for your home, basically? So
there's one question I've got. It's one. I've got a video called Charlie's 10 Golden Rules for Home Sellers, which is really popular, actually. I'm really happy to see that video gets a really consistent number of views every single day with sellers looking at it. But the one question, the only question a seller needs to ask an agent is this: I know the market will determine the price at which my house sells, so I don't want a valuation because that's a guess. What I want to know is, what do you do that other agents don't do that ensures competing buyers?
Yep.
What is the process that you follow that ensures that when I launch my property on the market, I get people through the door viewing that's the first step, enough people through the door viewing to then get competing offers. And roughly speaking, I mean, one of the agents I'm working with right now, they are getting about 1 offer for every 5 viewings. That's roughly speaking, which is a better than average. I remember going back in the CRM days when I had quite large quantities of data. It was an average of about 14 viewings per offer across all of our clients. So, but 5, if it's priced well, if it's really priced competitively, so that buyers go, this is good value, this is priced seriously, this is clearly a seller who's intended on selling, not waiting for some fanciful figure, then those buyers tend to buy it. And so you don't have to do as many viewings, you get it sold more quickly. So that's the question to ask. I say, and I know that, I mean, your entire existence is built around projecting values of stuff, right? And I'm here saying, no, it doesn't help. Guessing, you may or may not be right about your guess, but it is just a guess, and it's not going to affect the market. Again, the agent I was working with, they had a property that was on the market, and it had a trickle of viewings, no offers, nothing happened. They then took it off the market, and about 6 months later, it came back to the market, and they put it on at a significantly lower price, right? And it got so many people through the door that it ended up selling for more than the original asking price, proving that it's not what the property is worth, it's how well you create a market for it. And
Yeah.
what bidders are happy to offer is they get a feel for how much interest there is. And if there's a trickle of 5 viewings over 5 weeks, well, there's no excitement about that property, is there? But if you've got 25 viewings in 2 weeks, it's very clear that, okay, and then you create FOMO, and then the buyers will bid against each other. So yeah, anyway, so that's a much longer answer to that question. Let's have a look at this graph, because I think this is really interesting. So this is your section that says property tax speculation, about the budget obviously, hits demand and new listings over 500,000. And this is really interesting because you've got on the left-hand side buyer demand, on the right-hand side newly listed homes, and this is comparing this year's figure with last year's figure. And for properties priced under 500,000,
2/3 of the market.
under 500,000, yeah. So the amount of demand is basically the same as last year.
Yeah.
But over 500,000, you've seen a 4% drop in demand, and over 1 million, you've seen an 11% drop in buyer demand. Okay, so that's pretty sudden and striking, isn't it?
It is, and I think it's again, and this is the last 5 weeks since all the speculation started in the Times and the Guardian, compared to the same 5 weeks last year, basically. And this is effectively the plateauing I'm talking about, basically.
Yeah.
So yes, I mean, there's just, again, if you're just starting on your search or you're thinking about buying, and you've seen all these headlines, there could be quite a big difference in the bill you're going to pay. And so if you don't need to move and you haven't got a burning urgency, you're probably going to wait to the budget.
And I find this is surprising though. So on the right-hand side, the right-hand half of this graph is newly listed homes. So you've got exactly the same number of newly listed homes under 500,000 as this time last year.
Yeah.
7% fewer above 500,000 and 9% fewer above 1 million. Now, to me, that's counterintuitive. And if I was someone above 500,000 or £1 million, and selling was an important thing, I would have been hastening my sale. I would have been hurrying, and I would have been aiming to get an exchange before the budget. That's what I'd have been doing. And I think a lot of people who wait to see may well live to repent. Sorry.
They might. I mean, the trouble is, if it takes on average 5 to 6 months to sell your property and complete at the land registry, I mean, the budget's in 2 months' time. So,
well, yes, you're talking about average agents, and of course, I only work with the elite agents who they're getting, the guys I'm working with are getting everything, literally everything under offer in under 28 days, and they're bringing it to the market so well prepared that they're exchanging in under 70 days.
But it's all that complete. It's the time to completion, isn't it? Basically, so
no, that's yeah. So, but that's like 68 days at the moment. So that's just over 2 months. So they're going from launch to exchange.
I think it's pretty tight. And again, I think it's most sellers and buyers, as we talked about. So and look, I think it's only 2/3 of homes for sale are under 500,000. Look, if the government, I mean, it's just speculation, but the government did abolish stamp duty under £500,000, the market between 250,000 and 450,000 would fly, basically. But I think it would have more repercussions for this top end of the market.
So this is interesting. So this graph is showing year-on-year price growth for the different pricing sectors.
Yeah.
So is that yeah? So you've got
just looking at the
200 grand. 1.7% between 2 and 300, 0.6% between 3 and 500, but zero growth over 500,000. And I think that reminds me of the other point I wanted to discuss with you, which is that I get a steady trickle of followers, sellers saying, we had no idea that we weren't going to be able to sell our home. We wanted to downsize and use our difference for our retirement. And first of all, we can't sell at all. And B, now looking at the price we're going to have to sell at, we're not going to be able to afford to buy, because what you're downsizing to, there's more competition over. And now we thought we were okay for our retirement, and now we're not, and we don't know what to do. And that is it's a repeating story, and I think a very sad one, because these are people who they haven't been greedy. They've lived there a long time. They've looked at online valuations of what their house is worth, And suddenly that's not the case, in such a way that the material impact on their lives is very upsetting. And they don't know what to do. And they don't know, do we just take the hit and downsize and tighten our belts, or do we stay put in this larger house with bills that we can't really afford because we can't afford to downsize? And stamp duty is obviously a major factor in that sector as well.
Yeah, I think it depends. Again, it's maybe reevaluating where you want to downsize to, basically, and comes back to my point earlier about the empty search box, right? Where I want a property of this size, of this price, which has got the following, close to this, close to that. Maybe I could open maybe there are other areas I haven't quite thought about where I could look. I think there's always a challenge with downsizing in this country. The reality is you need to be in quite a large, very large 3-bed or a 4+ bed home to just make the numbers add up to down trade to a 2-bed, right? I mean, it's 50% of all homes in this country are 3-bed houses, and because we've got a scarcity of 2-bed properties, the price of 2 beds is artificially close to 3 beds. So most down traders want to take 100 grand out. Well, if you look at the sort of even moving within a local authority on what you have to live in to make it worth to release 100 grand, it's actually, you've got to live in a pretty big house, basically. And so I think that's the real challenge for people in a classic 3-bed semi, 3-bed terrace. And again, a lot of people don't want to move into flats, and sort of might not like the idea of that. And there's a real lack of 2-bed houses. And again, the 2-bed house is what the first-time buyers want to buy. It's what the investors have been buying. So you're absolutely right. There's a lot more competition at the sort of smaller end of the market. We desperately need more 2-bed houses in this country. And I think the only way to really, the way for anyone thinking about this, I think it might be very challenging for a lot of people to downtrade in their existing local area, because, say, the price of 2 beds is often quite close to the price of a 3-bed. I think if you're trying to go from a 4-bed plus house to a 2-bed, it probably works. But I think if you're going for that classic British average, half of all homes 3-bed houses, it's really tough. And you probably got to move to a different area, or, just think of another plan, which is probably not what you want to hear. But I think there are options to downtrade, but you just have to have a different plan.
Yeah, and it's happy times for upsizers at the moment. Let's start to take some questions. Ramble and Root says, would Richard like to see stamp duty scrapped? Do you think it would help more people buy?
Absolutely. I mean, I think it's everyone hates it. Every big economist, every well-known economist. It's not people in the property industry. Yeah. It's people like Paul Johnson, ex-head of the Institute for Fiscal Studies. Lots of people saying it's just bad. I think Dan Needle says it's bad. He wants it removed. So the trouble is, it generates £10 billion a year for the government. And it's a lot of money, right? This is all to do with George Osborne's changes. So with all the headlines we've got about the government being slightly strapped for cash and needing 20 to 30 billion quid more, losing £10 billion in a flash is easier said than thought about than done.
If you were to remove it only on people buying and selling their first or their only home, then the amount drops to just under 7 billion.
Yeah. I think what we should, we should just, because I think it depends which way you cut it. I think if they did scrap it, they wouldn't scrap the tax on the overseas buyers, and they wouldn't tax this. They'd keep the 3% band, basically. So they probably might lose half the money, basically. So it
would make sense to encourage downsizers to downsize. That would really, really make sense.
I think it's how do you get, and it could have quite a big boost to activity. And if the government wants more homes to be built, there's a mass, again, given that 2/3 of homes are less than £500,000, if they had no stamp duty to pay, it would really provide a boost to the market. But I think a lot of people buying over £500,000 would start to think about, well, hang on a minute, my stamp duty was 60 grand, but now I've got to pay this annual tax, and I plan to be in this property for 20 years. Hang on a minute, that's way more than I would have paid in stamp duty. And all of a sudden, it would probably impact, I think, what they would pay for the property. So, again, it all depends on how it's brought in. But I think everyone, every big economist, anyone looking at, if we're all about economic growth and building more homes, we need more liquidity in the housing market. And obviously, everyone would love stamp duty to be cut for everyone. it's hard to see the government letting off overseas buyers and people buying more than one property.
Now, I'm not sure whether you'll know what this question is referring to, but Robert Jackson on YouTube asks, Richard, do you think the 80% interest-only mortgage for first-time buyers coming in are going to give a temporary boost to the market in the short term?
I think there was a story out today about a bit of mortgage innovation from a certain lender. I think it was Generation H, trying to innovate. I think, look, lenders are trying. There's a lot of innovation out there as lenders try and help people access home ownership with different products. I think it was part in, I didn't read the full description of what the product is. I think it's part interest only, not fully interest only. So, and I think that the challenge, it doesn't, even this, it's all about helping first-time buyers get through these mortgage stress rates and these loan-to-income limits. And the Bank of England has given lenders a lot more flexibility now on stress testing people at lower levels. So if you give an example, in January this year, a first-time buyer going to a big high street lender would have said, look, I want to buy this property. I'm going to pay 4.5% on my mortgage. Those monthly mortgage repayments are the same as my rent. I can afford it. Surely I can get the mortgage. The bank could have said, hang on a minute, I need to see whether you can afford 8.5% or 9%. I say double. And of course, a lot of people wouldn't. What's happened is, in the last, about 5 months ago, that 8.5 to 9 has gone to 6.5 to 7. And so that's given people 20% more buying power. So that's supporting first-time buyer numbers. This is further innovation. I just don't think the volume of this product's going to be massive, right? So if they say, I can't remember what the exact number is, but there's about 350,000 first-time buyers a year. This product, I don't know what the numbers would be, but it might be hundreds at best, if you see what I mean. So,
okay, it's not going to move the needle. Yeah, okay. Now, this is an interesting question. Leslie Smith on YouTube asks, Richard's index seems to include the whole housing stock, which is correct. That's what you said at the start of this video, i.e. all houses that are not for sale. How can this be relevant to an index which ought to indicate what the current sales market is doing? And that, actually, before you answer, reminds me to put this up on the screen, which was what I showed you before we came on air, which is the best agent index that today, hang on a second, shows that the median asking price. So this is the whole, hang on a second, let me just hide the question, make some more space. Let's just do this. It's really interesting because the median, so these are asking prices. This is my website, Best Agent. And this is England, just England, right? Not UK, it's only England. And it separates out asking prices. So we've got 166,000 properties marked as sale agreed in England, of which the median asking price is 300,000. That's not the sold price, that's the median asking price. And that, by the way, that median asking price of properties marked as sold has not budged once all year. Absolutely rock solid, hasn't changed. The median asking price on the next line down, which is for unsold stuff, the stuff that's not selling, of which there are 546,000, so over 500,000, that hasn't budged all year from 340,000. And now it's just this week dropped from 340 to 335,000, which I find interesting. That's just a raw median. There's no weighting. There's nothing else. But this, to answer Leslie's question, this index is just purely what's showing on the market. It's only asking prices, no sold prices. There's no further breakdown by north or south or property type. But I think Leslie makes an interesting point. Right? She's like, well, okay, this is all well and good that the Zoopla stock is the value of the entire housing stock. But what's happening in the sales market? That's what they want to know. Why can't we sell our homes?
No, look, I hear you, and it comes back to that point about, are indices macroeconomic tools, or are they designed for homeowners to make decisions today or tomorrow? I think I'd say two things. Again, it's a bit technical. There's this concept of transaction bias in the housing market, that there's a different kind of mix of homes that are for sale compared to there's 25 million homes in the UK. And as you've just said, there's 500,000 that are currently for sale. I can tell you now there'll be a difference between the profile by type and value of all homes, all those 25 million homes, and the 500,000 that are for sale. And you've done it yourself with what's selling is 300 grand, what's not selling is 335 grand. And we think the median value of all homes, all 25 million homes, is 270,000.
Right.
So I think what
Exactly
you tend to find, I think, and when I look at the price of newly listed homes, they're always higher than actually the price of everything. So this comes back to your point that the stuff that is slower to sell is the more expensive homes, the higher value homes, where there might be less demand, but it drags all the numbers up. So there's one point about transaction bias, about if you just look at what's for sale and what's selling, is it really representative of the whole market? And again, look, an index is supposed to represent the basket of goods. The CPI index, the RPI index are trying to track like for like. How's that basket of goods price changing? And that's the same thing we're doing, what we're supposed to be doing with indices. I think the waiting point I made was, I think the other indices are a bit more volatile, largely because they rely on mortgage lending data. 55% of all new mortgages are to first-time buyers. If we've got 30% more first-time buyers, and if our data shows first-time buyers are looking at more expensive properties, they're going to be sort of potentially getting hotter signals from the market than we're seeing. And again, I think if you adjust to the stock of housing, it's a technical term, this weighting to the stock of housing. And just to be clear, what we're not doing, and we could do it, every month we value all 25 million homes. We could produce a separate index. It's what is the value of all homes doing? What we are trying to do is to track what's the market telling us on signals, on mortgage valuations, sales prices, sold agreed. So I think all indices, they all move in the same direction over time, but you have to look at the different inputs and the different mixes and consider transaction bias to try and create a more of a like-for-like picture over time. So it's a bit of a technical argument. The good news is when we benchmark our Zoopla Index to what's sold over time, we do a pretty good job compared to other indices. So, and look, no index is perfect. It's all about giving a general direction of travel. And again, if you really want to know what the value of your home is, speak to an agent and make sure you ask them the right questions, or obviously track your home on Zoopla.
Don't ask them how much it's worth, because they'll just guess and they'll exaggerate to flatter you. Ask them how they get competing bids, because that's the only way to know what it's actually worth. Next question we have. Well, Brit in Switzerland makes an observation saying property is becoming a really bad financial asset. Illiquid, rises barely in line with inflation, and easy target for tax. Well, all of those are true right now, aren't they?
It's I think what I would say is that's the capital value side, but I think the cash flow remains really strong. Rental inflation, the underlying kind of rental from property, rents track earnings over the long run. And so I think at the end of the day, and I'm sure you'd agree with this, Charlie, at the end of the day, people, when they're buying their home, should be thinking it's a home. And you should just take what the housing market gives you in terms of house price inflation. Don't buy property thinking you get a ton of house price inflation. It's a brilliant place to live. It's somewhere you love living, bring up your family, down trading to or whatever. So, for homeowners, and I think homeowners stopped seeing homes as financial assets when buy-to-let arrived, because you could become an investor with someone else's roof over someone else's head rather than your own. And I think for buy-to-let, there's just been a big shift now where it's not about the capital gains anymore. It's about the strength of the underlying cash flow. You could argue residential investing has become more like commercial property investing, which is the strength of the cash flow. Part of my pension.
Yeah, you're right. And it's the experienced professional landlords who know how to make this market work for them, and all the retail buy-to-let investors are getting cooked. And I know families where they've just worked really hard. These are not wealthy people, right? They've worked really hard. They've paid off their mortgage. They've made an assumption that it's their nest egg. And when they've come time to cash in their nest egg, there are no eggs in it.
Well, I think the other thing I've heard that sort of surprises me is I've heard tales of first-time buyers who can't buy deciding to buy a buy-to-let and thinking that's a sort of way to getting a step on the housing ladder. What was your advice to a first-time buyer doing that, or would-be first-time buyer doing that, Charlie?
They've been listening to the snake oil sales guys on social media who are telling them how to get rich quick and how to, you're never going to earn enough money from your wages, so do something else. It's proven and guaranteed, and look how rich I am. And it's incredibly seductive. It's incredibly seductive to people who otherwise can't see a way of earning enough to have a decent life. And it's just horrific exploitation of false hope. I hate it, because I've been a landlord myself. I know many big ones, small ones, medium ones. I've had them as clients, estate agents, managing portfolios. I've built lettings management software. I really understand it. I understand the whole investment ethos from my days back in the city about all the various dynamics of investments. And it's really complicated. And if you're not trained in this stuff, you're going to get eaten for breakfast by the market and by the investors who do know what they're doing. You're going to get outmaneuvered left, right, and center. You're going to get outmaneuvered by tenants. I've seen that happen to landlords I know. I've seen savvy tenants who know the law, and they've run rings around these landlords in court. I know one landlord who tried to take his tenant to court for £25,000 of unpaid rent and ended up having to, they got the court and it went the other way. And the court found that the landlord had to pay the tenant something. And so that's my answer to a first-time buyers thinking about being buy-to-let investors. You are rolling the dice, and you might know a few people who've done okay with it if they were very careful and they got lucky, but it is not a sure thing. It just isn't a sure thing. Either do it professionally as a business, that's fine. And I agree with Richard that if you're very, very careful and you buy wisely, get a decent rental property, get a good tenant and a good return, then there is real money, real cash returns to be made on your investment there. But you need to treat it as a business, not as an investment, not a set and forget investment. It's a hands-on business of managing a portfolio. But unless you're prepared to do that, you are going to get chewed up and spat out by the market if you think you're going to make easy money as a buy-to-let landlord. That's my view. Unusual question. Don't know what your answer will be to this. Hardstyle is a religion on YouTube says, do Zoopla do a backcast when a property sells, comparing its valuation before sale and the sale price? Interesting.
We have done this. I can't remember the stats immediately to hand. I need to double check, Charlie. I haven't got the numbers off my head, but we do check. I think, look, the key thing about valuation is it's quite easy to value liquid properties that are very homogeneous for their local area. You're valuing 3-bed semis where there's a ton of liquidity, it's fine. Clearly, automated valuations struggle with properties that are different, overly large for their area, overly small for their area. The classic example is the equity release market, where an older couple might have been in their home for 40 or 50 years, might have not done so much repair and maintenance in the last 10 years. It's a property not in good condition, right? And so you do get a lot of variances, basically. But for a high confidence valuation, even a medium confidence valuation, it's a pretty good estimate, basically. And I think it's then flagging to people those outlier properties that are different to the norm, basically, where again, the market needs to work out what it's worth, basically, by putting it on the market.
Richard, we're coming up to the wrap-up time. I'm incredibly grateful to you for giving up your time in the evening like this for the audience here and for me. It's been a fascinating conversation as ever. Just want to let everybody know that if you want to follow Richard's musings on, he's arguably the best equipped person in the housing market in terms of what data he has access to of anybody, because you've got your fingers in all the different pies of the land registry and the lenders and the agents and the CRM and Zoopla. You really do have the whole basket. So your insights are very, very interesting. And you can follow Richard for his insights on X at Richard_Donnell. But is there any parting messages you'd like to leave for my moving followers and the agents watching?
Exactly. Well, you can also follow me on LinkedIn, where I do a bit more posting at the moment. I need to get back onto X, but thank you for that, Charlie. Very kind. No, I think it's I think the housing market's set fair. We should be pleased on the one hand that we've got this sustained recovery in sales and more people are moving, which is the best thing about this. We don't need a lot of house price growth. I think just there was a lot of hope that mortgage rates would fall faster than they have done. I think everyone's just got to be realistic about mortgage rates probably staying more or less where they are at the moment into next year. So don't delay on, but if you're serious about moving and you want to get confident, listen to the right people in the market, talk to your agent and grill them a bit more about just to get that price realism right. But yeah, just don't delay waiting for what might be in the budget, might or might happen to mortgage rates. Do your research, get all your information together and try and find the right information to be as confident as possible to make the right move and bid the right price on a property.
Fantastic words of wisdom, Richard. Thank you very much. I hope you'll come back again one day. All the best, and thanks to everyone for watching. And